The recording has started.
Okay. Well, hello, everyone. And please join me in welcoming Barbara Matthews, who's the founder and CEO of BCMstrategy Incorporated, to talk to us today about how to hedge headline risk during a pandemic. The topic is going to be on next-gen scenario analysis, the do's and the don'ts. So, Barbara, I'm going to go ahead and pass you the controls. If you can share your desktop, let's get underway here.
Since we finalized these slides, fortunately, they remain relevant and hopefully helpful to you. Our agenda is big. We're going to talk about scenario analysis generally. We're going to talk about 2020 data issues that have arisen since the pandemic, which only makes the job of a risk manager and that much harder. We're going to talk about the benefits and the pitfalls of alternative data. And then we're going to talk about some predictable inflection points that can be used to provide scenario analysis and portfolio risk assessments in the current environment. And finally, we'll close out with some resources. First, some scenario analysis basics. And before we get into that, we have a small poll. I'm launching the poll now. When one is at the tail of the distribution, proper scenario analysis is impossible because no data sets exist for the current environment. True or false? Please select one. Five, four, three, two, one. Closing the poll now, and I'm sharing the results now. We are almost evenly divided. The correct answer actually is false. And for those of you that answered false, the funny part was that the people who answered immediately were the ones who were all answering false. So the people who knew it was false knew it right away. Why is this true? Well, first we have to talk about scenario analysis generally. It's the process of estimating portfolio or asset expected values within a defined time period, assuming specific changes in the values of portfolio securities and or key factors that impact all of the portfolio securities. So, the process of risk quantification in the last 20 years has generated the expectation that in order to conduct scenario analysis, you need a lot of quantitative data. And when you don't have that, many people then assume that the job of the scenario analysis activity is the equivalent of throwing darts at a dartboard on a Friday afternoon. What if? And you can create any number of what ifs and then change randomly the parameters in your portfolio. Random shifts in assumptions and parameters are going to generate similarly random outcomes, and that doesn't give you any particular insight into whether the risk embedded in your portfolio is a real one or not. And so misconception number one about scenario analysis is that it's really no more than a dartboard. I'm going to challenge you to think about whether that is true. The second misconception is that event risk is a random variable. And by the way, this is why a lot of people think of scenario analysis as if it were a dartboard. Because they think, well, event risks, they come from out of the blue. And you cannot possibly predict that those are going to occur. Common categories include weather phenomena, predominantly earthquakes, not so much hurricanes because you can see hurricanes coming, but earthquakes. Many people like to talk about political risk in this context. Now, event risk is a big term, but I'm going to suggest to you that event risk is actually a much smaller universe of random events. And I'm going to also suggest to you during the course of this discussion that most public policy risks do not fall under this category. Misconception number three, artificial intelligence is the answer. Many people, especially today, have concluded that since the goal is to throw as much into a scenario analysis as possible, and since the goal is to replicate some level of randomness, then the answer must be to automate the entire process, because a computer can generate far more scenarios than any individual physically could. I'm going to suggest to you this also is not accurate. And the reason for that is that in order to generate, and this is a very hard truth for many to appreciate, is that to generate meaningful insight into risk exposures, scenario analysis requires concrete, recent, and relevant data. In other words, whether you're automatically generating random variables through AI, or you are throwing a dart at a dartboard, they're not conceptually that different. They are not going to give you relevant data to stress individual components of your portfolio, because they're not connected to real world risks. And the key to doing scenario analysis correctly is to focus on real world risks. Now, we have a couple of problems in 2020 specifically, because even though ironically we are in the middle of the data revolution, we have more structured data than we've ever had before available to us literally at our fingertips. We've got more computing capacity available to run through that data in a coherent manner. And then on top of it, we have more capacity than ever to convert unstructured verbal data into structured data. We are awash in data, and yet we have a problem in 2020. And the reason why is that the pandemic is creating very real problems that we aren't even really seeing yet, but we're about to find in the data stream. Regulatory reporting deadlines from March onwards have been delayed. Financial institutions are not delivering to policymakers, and companies are not delivering to statistical organizations in their business data in a timely manner. And on top of that, we have the prominence of public policy event risk. We have policymakers making decisions very quickly, more than they usually do. This was particularly true in March and April. And on top of it, the breaks in the data series make it really difficult to identify where the challenges exist. Scenario analysis has become more like weather forecasting during the pandemic for the same reason. With fewer planes flying, the weather forecasters are deprived of meteorological information that commercial airplanes gather and report to them. So predicting the weather actually during the summer is going to be a little bit more random and a little bit harder to do, just like identifying economic trajectories about to become more difficult. Measuring risk is about to become more difficult because the data won't be as good for a certain period of time, hopefully just a few months. But the breaks in the data series create significant issues when it comes to risk management and scenario analysis. In addition, the low data challenge goes to the core of the risk analysis process, because we are living in a tail event, actually two of them simultaneously once you count the current civil rights discussions, protests, violence, looting, etc. The tail events make it much harder to identify where we are in the distribution. This therefore means that in order to conduct scenario analysis properly, rather than relying on reams of historical data to assess what may or may not be an appropriate variable to adjust when you're doing scenario analysis, you've got to really start focusing on nowcasting. Fortunately, last year we wrote about nowcasting at Interactive Brokers. We had a series of blog posts called How to Trade the News. and it was the top 10 rules for how to trade the news. We're highlighting here on this slide rules 7, 8, and 10 on nowcasting. The basic point is that when you're in a situation when things are changing rapidly, and that's really when scenario analysis matters the most, frankly, the goal should be to align your time horizons and revisit your assumptions daily, rather than rely on past data. Focus on the data you have today. And when looking particularly at that category of event risk called political risk or policy risk or geopolitical risk, it's crucial to look past the headlines and look at what policymakers are actually doing, rather than look backwards to see what they've done in the past. The average human trader can perform this function far better than an automated bot, because a human can identify instantly the difference between action and rhetoric. And a human knows that a leak to the media may not always be a decision. And for additional context on how to distinguish among those types of activity in the policy process, I encourage you to look at those blog posts. We also have an ebook in on our website that sums it all up. The key takeaways for the moment, in the interest of time to move forward, the key takeaways are that policy risk can and should be measured, and it especially should be done during a crisis, because that's when your risk profile is changing the most. And while advanced technology, like the technology we use, frankly, at BCMstrategy Inc., to monitor and measure the news cycle, while it can help minimize your headline risk and increase your operational efficiencies and increase your ability to exercise strategic judgment, the reality is that it cannot substitute for the strategic advantage a human acquires when they conduct nowcasting armed with technology advances. Alternative data is a way to get there. In other words, in a universe where traditional historical economic data is either unavailable, as it is right now for certain vectors because regulatory reporting is delayed, or if you are looking at the world very differently because you have access to so much and many different kinds of new data, it's important to understand the benefits and the pitfalls. Again, how to trade the news, the blog series at Interactive Brokers last year covered this in rules 4 and 9. We looked at a range of data to sum up the traditional economic data, GDP, purchasing managers index, trade flows, etc. I mean, they're still important, but because we live in the data revolution, there's a lot of additional information available to you for making decisions that you can use in scenario analysis that maybe you hadn't thought of before. So there's alternative data, which is really just a digitized version of data you already have been using for various risk assessments. So that's habit data. It's often generated by the Internet of Things. So that would be geolocation data, browsing patterns, things that you were used to using in analog format, and now they're digital. And then there's entirely new data that never existed before, generated by machines. So that's when unstructured data, words, have been converted into sentiment analysis, when words using our system have been converted into action data, when new correlations have been discovered. All of those components are totally new. This is frontier territory. It's very exciting. But the point is that there are, when you think about using all of that new data, you can identify new inflection points. You can engage with the news stream in new ways, and you can conduct stronger and better scenario analysis, even when traditional economic data may not be as reliable an indicator of future activity as it has been in the past. Before we get into the concrete examples, I did want to run another poll, and I'm pulling it up right now and launching it. So here we are in June of 2020. We have had quite a series of event risks, and the poll right now is, what is the largest concentration of risk on bank balance sheets right now? And since this is a very well-informed audience, the answer is, I'm not going to give you the answer, but if you ask the question, what banks are we talking about? I'm talking about all the banks, United States, Europe, any big, small. What is the largest concentration of risk on bank balance sheets right now? Five, four, three, two, one. Closing and sharing the results. Most of you said credit risk, and by a large margin, I might add, 67%. The nearest next category was sovereign risk at a tiny little 11%. I am so sorry to tell all of you that, in fact, sovereign risk, if we were to use this this distribution, sovereign risk probably should be 90%. And why is that? And the reason is that for every single credit risk on a bank's book right now, whether we are in Europe or the United States or Japan or anywhere else on the planet, especially in the advanced economies, the sovereigns have stepped in to guarantee private sector risk, corporate risk in particular, but often mortgage risk as well for qualifying risks. So the point is that the sovereigns have stepped in and substituted their credit risk in order to ensure that in March, April, and May, credit risk, private sector credit risk, did not generate automatic downgrades, losses, and general deterioration of portfolio quality. If you're in a universe where the majority of banking risk is now sovereign risk, you are also in a universe where policy risk is a much bigger component of your portfolio than perhaps you realize. The average person, the average trader, the average analyst, scenario analysis architect is going to say, oh my, well, that means that risk has become more random because now there's so much more policy risk embedded in these portfolios than we realized. And I'm going to challenge you to see it differently. So at BCMstrategy Inc., and you're seeing a slide right now, I'm going to explain to you what you're seeing. At BCMstrategy Inc., we use patented technology to convert the words of the public policy process into structured numerical data in an objective way. So this is not sentiment analysis. In February, we started tracking policy activity from finance ministers, banking regulators, central banks, legislators globally on how they were reacting to the COVID-19 situation. So we have what I think is probably the only time series of the entire public policy response function from monetary policy and fiscal policy and trade policy and banking regulation. And not surprisingly, the ramp up was, as significant as the pandemic itself, and it has leveled off. It has leveled off not because the pandemic has disappeared, but because they've pretty much run out of things to do. There are things that can be done at the margin. One of the many things that were done in this steep slope up to what are the highest readings on our platform to date for any policy area were, among other things, to substitute sovereign risk for credit risk on bank balance sheets. That wasn't the only thing that was done, of course. The point is, we've been watching that for quite some time. If you know that at the end of May, your sort of elevated level of activity remains constant and you can follow it every single day, then your ability to conduct nowcasting, your ability to identify likely moves from here increases. You don't have to use wild imagination. To illustrate the point, this is the detailed March chart for coronavirus public policy activity. The red circles here indicate inflection points. Wherever we see the green action line meeting or exceeding, in other cases they have exceeded, the blue rhetoric line, it tells you that an inflection point has occurred. And by the way, that inflection point was just on the eve of a global lockdown. This is March 9th, was right as the northern Italy was being locked down. And what followed thereafter, of course, was a series of global lockdowns, the only simultaneous lockdown of G7 economies ever recorded. At the end of March, we had a very different kind of inflection point. This was when the Congress in the United States was having great difficulty coming to agreement on a stimulus package. And coming into the end of the month, rhetoric was going parabolic, but action was non-existent, which meant everybody and their dog was talking about the need for additional fiscal action, but policymakers were doing nothing. High risk moment. Anyone watching it on a daily basis, as our platform users were, and our subscribers, could see that and could prepare accordingly on a day-to-day basis. Viewed in the aggregate, and these are momentum measurements. These are momentum measurements on the same day for four different types of issues: trade policy, Brexit policy, COVID-19 policy, and banking. So this is a picture of financial system distress, because while plenty of policymakers were talking about the coronavirus and taking emergency action on COVID-19, and while there was some activity on Brexit, the sector that was seeing the most disaggregated, differentiated, and distributed momentum and concrete action was in banking. And why was that? Because that's when the banking regulators were pulling together all of the policies that have kept our system floating, whether that was swap lines, whether that was relaxing significant components of the Basel III framework, whether that was relaxing regulatory reporting requirements. We don't even have time to go through everything that they did right now. The point is that when you see the policy cycle represented objectively in a quantitative manner, this is alternative data you can use to craft your scenario analysis in a much better, more granular way than, at a minimum, than using a dartboard. So with that, I'm going to launch the next poll. And the poll is, what is the most likely risk for technology companies globally during 2020? So obviously technology companies have been having a good crisis. They have been having a very good pandemic. Everyone is using them. And the question becomes, especially during the second half of the year, what's the biggest risk that they're going to face? With every boom, you don't always get a bust, but at some point the boom levels out. And with that high a level of engagement, that much volume, they are building up risk somewhere. And the question is where? Where are they building up their risk? 5, 4, 3, 2, 1. Closing now and sharing the results. So you were evenly divided. I vaguely think that my showing that slide help some of you out. um, while all of these, and all of these are very real risks, the most likely risk for technology companies during 2020 is actually the tax liability risk. And the reason for that, and I'll go through the substance of it for a minute, operational risk is ongoing, but the technology and cybersecurity risk as well is very significant. But these are well known, and the main technology companies, the global giants, this is in their backyard. They know this. They are on it. I can't say they're invulnerable, but they know this is coming, and they have been preparing for it. And so I would suggest to you that this is not as likely a risk. Part of the definition of risk is something that comes from out of the blue. Antitrust and competition policy risk is a real risk as well. However, it takes a lot longer to change that policy. The biggest risk to their bottom line, frankly, is the tax liability risk. And the reason for that is shown in this time series. So for those that don't follow this issue, I'm going to kind of walk you through the chronology of the first 5 months of this year. Prior to the pandemic, the European governments, particularly France, were making great strides toward taxing global revenues from the internet giants. At the end of December, the Trump administration filed and concluded a trade policy review, decided that an internet tax was an inappropriate barrier to free trade and threatened retaliatory tariffs. This is why rhetoric was so high in January. The rhetoric dropped during the pandemic, but not because of the pandemic. It started dropping precipitously because the United States and the Europeans, and frankly, a number of Asian countries, came to the conclusion that they needed a global standard, and so they agreed to negotiate at the OECD. And that was before the pandemic hit. Since the pandemic, of course, governments in the advanced economies have been spending so much money that they don't have to keep the economy afloat. At the same time, the companies that benefit the most from the pandemic are seeing bumper crops in revenues. And so they become extremely attractive targets, greenfield revenue. And this is why in April the rhetoric started going up. It was going up almost exclusively from Europe. By the time the end of May came, multiple European companies, European governments were saying that they were going to move forward with a digital tax with or without the OECD. And in fact, that includes not just France, it includes the UK, it includes Spain. Spain's parliament is actually moving forward already. They are voting on it, and they have promised that if the law they enact before July is finalized and it's different than the OECD consensus, then they will move on and amend their law, but they're moving forward anyway. A digital services tax established on the basis of global turnover or global revenue assessed by every sovereign on the planet is, I would argue, a far more significant risk to the revenue stream and the profit of the main technology companies on the planet than any of the other issues combined right now. Going forward, we could dive into any number of these issues. We don't sadly have the time for all of them. These are the kinds of issues we are looking at on a daily basis. And any incremental move visible on our platform can provide the foundation for very scientific scenario analysis on any one of these issues. We could go from the hyper-technical issues associated with transitioning away from LIBOR into market-based benchmarks in each country, which creates significant operational and legal risk, not to mention actual market risk. We could talk about fiscal policy in a great deal of detail, and not just fiscal policy, but if you think about the way fiscal policy is changing because of the pandemic, it's also raising additional issues that actually saw a lot of activity even during the craziness of the lockdown era. For example, central bank digital currencies have seen more action in the first part of this year than all of last year combined. And why is that? Because governments, including the United States, have realized they need more effective ways of distributing emergency fiscal resources to individuals. So this is causing the central banking community to accelerate their assessment of some very difficult risks, very difficult issues associated with, should individuals have a direct account with the central bank like a bank does? If not, that means an individual needs to use an intermediary. Should that intermediary be a commercial bank? Should it be a payment system? Should it be an unregulated third-party company that happens to be a technology giant? The policy answers to these questions are not easy. The Green New Deal, whether that's in the United States, which is losing a lot of momentum, or in Europe, where it has really just taken off, using fiscal resources to promote particular policy priorities. And I could have added in here not just 5G, but a broad range of digital technology policy issues. This is where real alpha is generated when you see public policy shifting so dramatically in this space. Much of that doesn't make it into the headlines. And it's not because it's not important, but it's because on any given day, there are other more important issues that most people want to read about. Credit risk and sovereign risk, we have talked about that already through the polling today. But when you are conducting scenario analysis, think about the debt to GDP ratios. So the classic economics rule of thumb about what constitutes a stable or sustainable debt to GDP ratio is about to change. And if it isn't about to change, it means that we now have far more sovereigns that look like Italy than look like the United States, which is not a comforting thought when you know that those same sovereigns are also standing behind significant amounts of corporate credit on the books of the commercial banks. Civil unrest and social justice issues, this is not put here as a negative. It is a risk factor when you think about sovereign risk. Political instability is never good for sovereign risk. How that is assessed and stressed and played out in scenario analysis depends critically on the structure of your portfolio. It can inform how you view today's bond spreads or today's FX spreads. Climate change and energy policy, same story. Whether that is directly related to fiscal stimulus activity or not, we track it on a daily basis, and so can see sometimes minute shifts in technical policy that impact rather dramatically if not the cost, then certainly the availability of affordable energy or renewable energy. Technical issues, any number of technical issues also covered by our platform, but just in general, when you think about your scenario analysis planning, with so many people using third-party technology platforms, the data privacy issues, which have been taking a back seat to date, I think are going to take a much bigger role in the public policy dialogue in the second half of this year. All of the rules that were relaxed in March and April, and I do mean all of them, really have gutted the Basel III framework. Having gutted it, if your analysis of bank credit risk in your portfolios is still keyed off of the Basel III standards, you need to look at very significantly every one of those relaxations. They were relaxed on a temporary basis, but temporary really means at a minimum 12 to 18 months. That's a long time to be relaxing standards without there being some kind of impact. And if you aren't looking at those, you need to be. Default rates and unemployment are pretty obvious, the unemployment especially. The default rate, so the default data first is a lagging indicator, of course, but more importantly, if you weren't aware or you didn't notice because so many other things were going on, the actual definition of default has been relaxed, both in Europe and the United States, as a consequence of the pandemic. In fact, the only public policy area that has seen no real slowdown has been Brexit. If anything, oddly enough, the pandemic has accelerated the negotiations and seems to be increasing the likelihood again of a no deal. If you want to think about accelerated risks, those are very much in the geopolitical area. This has been in the news, of course. The dispute over who knew what and when about COVID-19 has really broken open a very significant rift between the United States and China, with ripple effects into the G7, which, by the way, has unified the G7. You don't see that in the news very much, but again, if you take out a lot of the headlines, you can see very clearly the G20, the EU, the transatlantic relationship. So far, this hasn't played out in the FX market or bond spreads. So that means it's a great time to be thinking strategically, because the autumn is when a lot of these policymakers are going to really be back in force. Finally, very much in the news, the shattered supply chains and trade policy shifts have been a very significant problem. These are related. The post-war global economy was keyed on a multilateral system that relied on all of the sovereigns to see that there was mutual benefit to being interoperable. The coronavirus calls that very much into question, and that's before we start talking about pre-existing populist politics and digitized supply chains. Again, being able to track sometimes arcane policy and see the trajectories shift every time those arcane policies change is important. So how do you keep a handle on all of these changes? We've got some resources. As I mentioned, last year we ran the How to Trade the News blog series, Top 10 Rules. You can find all of those still up at Interactive Brokers on our BCMstrategy 2 website. We also consolidated them down into one single ebook that you can download for free. On BCMstrategy 2 and at policyscope.io, we offer periodic blogging on various issues that come up. Basically, whenever, in particular whenever I see something really interesting, I blog about it. So whatever caught my interest on the day from the platform is available for free through these resources. And then finally, in March, because of the COVID crisis, we created a daily report. Yesterday, so too late to update these slides. Yesterday, we have renamed and repositioned that report. So that report is now called the Policy Scope Risk Monitor. Also available on the website. It's available through Interactive Brokers under the Research tab, and I think, Cynthia, you can probably show people how to find it on their Interactive Brokers workstations. The Interactive Brokers portal still lists the old title. It needs to be updated because we just changed it yesterday. But the point is that you can stay on top of some of these arcane components of the policy process using an objective, structured, numerical approach that is far better than a dartboard. It's not a crystal ball, but it's the next best thing to a crystal ball. We have 10 minutes left, and I'm confident that there may be questions. Cynthia, I don't know if you wanted to show people the how to access the research on the portal, on the interactive workstation, or whether you wanted to go with questions.
Well, Barbara, because of technical difficulties, I don't have that other application open, but I do want to let you know that through Trader Workstation, underneath the new window button that's available, you can find Analyst Research, and simply click on that and you'll locate the BCM Strategies button where you can access information. If you have subscribed, it will show there. You'll be able to access directly through Trader Workstation. Now, also, I would like to mention at this point, if you do have questions for Barbara, remember there is that questions panel that appears over on the right-hand side of your screen. Simply double-click the title bar and you can add any questions you might have for Barbara at this point. Also, excellent.
And so the question is isn't it important nonetheless to analyze market behavior past pandemics to determine future behavior? And I'm going to suggest to you the answer is yes and no. I mean, of course, it's always important to look at past behavior, but whether that determines future behavior is a completely different question. And I will suggest to you also that if you look at the World Health Organization, there have actually been a lot of events that they have labeled pandemics in the last 20 years. And they may have been systemically significant in the countries where they were prevalent. For example, Ebola in West Africa, and so sovereign bond markets, FX markets in those markets. But the current pandemic, I would suggest it is rather risky to extrapolate from that, because we really have never seen a simultaneous shutdown or near shutdown of all G7 economies. And so there are components of the current situation that I don't think are deterministic. If there were, and I would suggest as you look at them that you, instead of thinking about comparing like for like pandemic A to pandemic B, I think it's more helpful to think about major systemic ruptures and why are they different. Scale-wise, the current situation economically has actually even been more disastrous than the Great Financial Crisis, which itself was more disastrous than either the 1987 market crash or the 1929 market crash. They are the difference between market crashes are also very stark compared to the simultaneous demand and supply shock that we've been seeing with the pandemic. So I think it's very, very difficult. I'm not saying ignore past data, but I'm suggesting that it may not be as predictive as you think, and it may generate some false sense of security when it's more relevant to use as your jumping off point the decisions taken today or yesterday. That's what I mean by nowcasting. The nowcasting is more important. One of the things about public policy that is crucially important that is that the decision a policymaker or a government makes on any given day literally changes the trajectory, and it changes the risk parameters for everyone else on a going forward basis. So tomorrow, if a decision is taken today in country A, tomorrow when policymakers wake up in country B, they have a different set of options available to them. And so they won't make their decisions in isolation. They will look at what happened the day before. And if they're, and I know that because I used to be a policymaker myself. So if you know that's going on, why would you be assessing your risk or crafting your scenario analysis in a vacuum? Other questions?
Well, at this point, Barbara, what I would like to do is remind everyone, as you mentioned before, we've been running quite a few events with BCM strategies. I will be including a link to the website where you can access prior recordings and simply locate BCM strategies. You can do that with the filtering box and access all of the information or all of the previous webinars that Barbara has done with us. So if you'd like to go back and review those 10 rules, keep that in mind. Now, I do want to remind you all that we have been recording today's session, and each of you will get an email later on today with today's recorded playback, access to the webinar notes, which is available right now in the handout panel over on the lower right-hand corner of your screen. So you can download those before you do exit today's event. So with that, we are going to conclude our event here today. I want to thank all of you for participating in today's session, and look forward to seeing you on upcoming events as well. So with that, you can all exit today's event using the X in the upper right-hand corner of your screen. Thanks so much all for participating today, and have a great rest of your day.